here with Lacy Hunt of Hoisington. He's the vice president, and they manage $5.8 billion. He's an economist. I'm very happy to talk to him today. He's one of the few people that are invited to speak at the KC Research Summit. KC Research does these summits about twice a year. It's probably the best seminar or best convention I've been to regarding resources and investments and economic analysis. So being able to speak to Lacy and introduce him to our audience is a great privilege. Thanks so much for being with us.
Nice to be with you, Dan.
Lacy, I want to talk to you about the economy. A lot of people in this political environment, they're being told that if they just vote for the right person, things will change and we'll have an amazing recovery. When you look at the economy and you look at the demographic shifts of the baby boomers entering their retirement years and the birth rates of the younger generation, has the United States peaked in its economic prosperity?
Well, the broadest measure of prosperity is the standard of living. And the standard of living is measured by the median household income adjusted for inflation. The latest year is the same as it was in 1997. No improvement in 15 years.
Wow.
Very serious indictment. And one of the reasons for that is that the U.S. economy is massively over-indebted. We push the debt levels beyond what is reasonable. We're in what I call a debt disequilibrium. Since 1870, debt to GDP has averaged about 160%, 170% of GDP. That's public and private debt. And currently we are 200 percentage points higher. In addition, the quality of the debt's deteriorated. It's very important from an economic standpoint of what we do with the debt. And too much of the debt is going to finance current consumption. When debt finances current consumption, it's not going to generate an income stream to repay the debt. And so, in addition, a significant share of the debt is what we call counterproductive debt. In other words, we're making credit available to certain components of the economy that will not be able to repay the debt. We saw this in the housing sector. We lowered the credit standards and they couldn't repay. That creates a negative income stream. I think that may be going on in student loans today. The automobile companies and the major banks are lowering credit standards to make automobile loans. It's the same story that we saw in the housing sector. In fact, in order to make these automobile loans viable, they've just recently, in the last 6 or 7 months, have lengthened out the typical car loan from 6 years to 7 years. And so that's what they have to do because they're lowering the credit standards. Well, there's a certain benefit to the economy over the short term. You know, automobile sales are higher than they would be. The retailers are a little bit better off. But the fact of the matter, all of these things make us weaker. We're not going to cure a debt disequilibrium by getting deeper in debt. And that's the path that we're on.
When you look at our spending, I think it was roughly $3.7 trillion last year, and our revenues were $2.2 trillion. That's a lot of money you'd have to cut. At this point in time, it's like, how do you even reverse course? Because, for example, in my own life, let's say I get a mortgage to buy a rental property. It's funded or backed by the Treasury, and the tenant is on Section 8. They go to the grocery store. The government's helping with that bill as well. The Federal Reserve is keeping the interest rates low to keep the prices stable. There's so much spending and so much government support and, I guess, manipulation in our markets. How do you even reverse course from this at this point?
Well, it may not be reversible. What happens? There's a lot of very serious economic research that has looked at the ratio of gross government debt to GDP and its impact on economic growth. And what the studies have shown is that once you move above a debt ratio, this is just government debt, of 90% of GDP, that bad things begin to happen. Economic growth rate begins to deteriorate. Well, at the end of the second quarter, our gross government debt was about 15.9 trillion. We only had 15.6 trillion of GDP. So the gross debt to GDP ratio is around 102%. In addition, there is econometric research which indicates that once you begin to move above this 90 to 100% range, that the relationship between government debt and economic activity becomes nonlinear. In other words, each 1 percentage point increase in the debt to GDP ratio results in an even greater negative impact on economic growth. So we're in a spiral, and we may not be able to control it. In 2011, the four largest components of the federal budget were Social Security, Medicare, defense, and interest. The portion of the federal debt that we were paying interest on was about $11 trillion, in round numbers. In 2020, it will be 22 trillion. Now think about that for a minute. If the interest rates that the government is paying are unchanged between now and 2020, the interest expense will double. It'll go from 10% of the government's revenues to 20%. So by 2020, the three largest components of the federal budget will be Social Security, Medicare, and interest. Defense falls to fourth. And in addition to that, we're going to have very negative demographic trends. There's a very distinguished economist at the University of California at Berkeley by the name of Barry Eichengreen. He was a Yale PhD, taught at Harvard for many years, has an outstanding book called Exorbitant Privilege. And what Dr. Eichengreen has calculated is that without law changes in Social Security and Medicare, the federal outlays, which are now 25% of GDP, the highest since World War II, will reach 40% of GDP in 25 years. Well, for Dr. Eichengreen, this is not going to be able to happen. We're not going to be able to transfer 15% of GDP from your working households to your retired households. And so the demographic costs of government are going to explode. The interest costs are going to explode, even if interest rates remain stable. And so the federal fiscal imbalances are going to get worse. And so the risk is that, I don't think it's a risk for the next 5 years, maybe not even for the next 10 years. But the risk is that we're going to move toward what is known as the bang point. And the bang point occurs when the financial markets say we don't have confidence you will repay us. And then the government is forced to fall back to just its revenue base. We're seeing this happen in European countries today, and what, to my way of thinking, they are a signpost to us that we need to clean up our act very quickly, or else we will eventually be in their shoes.
With that happening in the United States, being the largest economy in the world, the United States controls the reserve currency. So in the history you were citing about things get bad when debt to GDP gets to a certain number, what happens when the biggest economy and the world reserve currency hits that? What is going to happen to the rest of the world with what's going on in the United States?
Well, right now, even though the U.S. debt is extremely high, let's do it in terms of total public and private. We're at about 360% of GDP. In the 17 euro currency countries, the figure is about 450%. Our public and private debt is about 55 trillion. We have 15 odd trillion of GDP. The 17 euro currency countries have $69 trillion of debt, and they only have 14 trillion of GDP. And so the European situation is much more indebted In the United Kingdom, their debt to GDP ratio is 500%, 150 points above the U.S. Japan, it's approaching 650%. So one of the ironies of the current situation is that there's nothing laudatory about the U.S. situation. But at the present time, we are the least indebted of the major countries. And so this provides a support for the dollar that's probably not deserved, but the foreign currency market is like a beauty contest. If you have 10 ugly contestants, the winner is the least ugly.
Yeah. So is the Federal Reserve going to do something like Japan, where are we looking at 0% interest rate from the Fed funds rate for the next, into 2020s?
Well, there is a new study that was published in April of this year by the National Bureau of Economic Research, which is one of the most prestigious research organizations in the country. They're responsible for dating the business cycles, recessions and expansions. The paper is entitled Debt Overhangs Past and Present, and the authors are Carmen Reinhart, Vincent Reinhart, and Ken Rogoff. Carmen Reinhart and Vince Rogoff teach at Harvard, very eminent researchers, all three PhDs from outstanding universities. And what they found is that since 1800, there are 26 cases of debt overhangs defined by having government debt equal 90% of GDP for more than 5 years. In other words, they wanted to eliminate short-term spikes in debt, but ones that are much more sustained. And they had a number of important findings. First of all, they find that once you go above this threshold, you start losing about 1.2% growth per annum. The second thing that they found is that the average length of these debt overhangs is 23 years. The average. And at the end of the average time, you lose a quarter of your growth against trend. And they also provide the first systematic evidence on the association between debt and interest rates. Now, you might assume that with the debt rising, and particularly government debt rising, that this would cause interest rates to go up. And by itself, it would do that. But the debt debilitates the economy. And Reinhart, and Rogoff say that those waiting for the detrimental impact of high government debt to exhibit in the interest rate markets will be waiting a long time. You see, it's the debt depresses economic activity, and the depressed economic activity trumps the other factors. And to illustrate this point, they quote from one of the most famous passages in literature, T.S. Eliot's The Hollow Men. And the final passage goes like this: "This is how the world ends, not with a bang, but with a whimper."